the whole idea of like the 6 rules of wealth is, number one is that you pay yourself first, and you pay yourself at least 10%. And that idea is that emergency fund. So many people don't have an emergency fund, but if you do have an emergency fund, wouldn't it be beneficial to maybe put it into play inside of an infinite banking policy so that you could learn the process, keep the money in your own family system, compound that interest, be able to take a loan against your infinite bank? Wouldn't it be nice if you had a banking system where you don't have to ask the bank permission, you don't have to go through the underwriting, they don't have to pull your credit, you don't have to go through that whole process? You can actually utilize your cash value life insurance policy. They're specially engineered and designed, high cash value, so that you can utilize them for your banking system. And basically, you can become the bank. You can learn the steps so that you can put your money to work just in the same way that the banks put the money to work when you put it into their account.
Hello, Money Multipliers. Welcome back to another episode of the Money Multiplier podcast. I'm your host, Hannah Kessler, and we ask ourselves, do our dollars make sense? Welcome back to podcast number 2 into the new year. I know we're probably getting back to work, getting into the routine of our daily lives with the kids, the spouses. So hey, just a reminder, take some time for yourself. I know we just got done with the Christmas winter break, and carry those same habits into the new year. Take care of yourself. So it's okay to rest, recharge for a little bit, and don't forget to truly treat yourself as your number one asset and your number one priority. So just a little PSA. So today's topic, I want to get into the savings account scam. And I have Tess Hulack joining me for another episode today. But before I turn it over to Tess, I just have a few thoughts that I want to get into. Because we, as the American people, have to go make money to live on this God-given earth we call America, right? And when we go and produce our money, what are our options that we're given of where we can store the money at? Well, the first one, the bank. Right? Why do I keep money down at the bank? Well, I don't know. That's just where they keep the money at. And when we deposit our money into the bank, we could have a checking account, a savings account, or maybe even a CD, a certificate of deposit. But in those savings and checking accounts, I mean, really the average interest rates that you're getting in there is anywhere from 0.3 to 1%. On a CD, you could be getting 4%. Maybe some promotional banks are giving you 6% right now. But the difference within the CD account, you're not going to have access to that money, right? Because you're putting this in here, you want it to compound for some time, and those dollars are being left in that CD account to produce the 4 to 6% growth. May I remind you that it is taxable growth, no matter if it's a CD, savings account, or checking account. And then what these bankers are doing, you guys know this if you're avid IBC participants, but if it's your first time here, hello, I'm Hannah. I'm here every single Tuesday. If you don't already understand, what these bankers are doing is they're taking our money, your money, and they're lending it out to other people, fractional reserve lending. So for every $1 that we, the depositor, leave there at the bank, that bank can now lend out $8, $9, $10 for every $1 that it has held back in their reserves. And a matter of fact, in March of 2020, the Fed actually came out with an article saying, hey, we're changing the status quo here, and now the requirement reserves to be held at the bank is 0%. So legally, banks don't even have to hold any capital on hand. Think about it this way. You know, if I take this same analogy of what banks are doing, and let's say I do it at a movie theater or a play. feeder, if you will. And let's say that I'm going there in the winter time and I have my winter jacket on, my big puffy jacket, and I walk into the theater and I see that they have a coat check. And I'm like, yeah, I'll go check my coats. I want to be comfortable while I'm sitting here watching my movie or seeing the play. So I check in the coat, they give me the ticket that matches up to the ticket number on my coat, and I go see the movie. When I come back out to receive my jacket, I expect to receive the same jacket with the same ticket number of what I turned in. But what if they didn't do that? What if they gave me another person's jacket and it's in the same value as my jacket, and they're saying, hey, here you go, here's the jacket back, it's in the same value. You should be happy because it's in the same value of the item that you checked in. And I'm over here thinking, no, I want my jacket. I look good in that jacket. This jacket that you just gave me is 2 sizes too large. That would be kind of crazy, right? So that's what these banks are doing. I mean, if you ever think about it, take a bill, a $20 bill, $10 bill, doesn't matter. If you go and you put your initials on it, and let's say you highlight that bill and you turn it into the bank, and you go back even in a few hours and want to request that same bill that you turned in, that you highlighted and put your initials on, do you think that banker is going to be turning back into you the same bill? No, they're not, because banks are in the lending business. They're moving the money out. They're lending out your money back to you or to other people, and they're charging us a boatload of interest to do this. And really, why people are going down to the banks and storing money there, or even requesting to get approved for these loans, is simply because we failed to capitalize our own lives. Remember when I said at the very beginning of this episode, treat yourself as your number one priority? When it comes into the realm of your wealth, you need to be paying yourself first, and don't be afraid to capitalize yourself, your family, your empire. And a lot of us just aren't taught the habits to do it. So I get it, all right? But this is a new learning that we have to go through, and we got to build up these new habits for ourselves. So obviously, banks, I can keep my money there. I could keep my money under my mattress in the safe in my house, or dig a hole in the backyard. Obviously, I don't want to keep cash on hand around here. I mean, yes, it is important. I kind of keep some cash stashed away in my home, okay? But I don't want to keep large quantities held here, because obviously I'm losing dollars, or my dollars losing that purchasing power due to the hidden tax I call inflation. That's a whole other conversation that I can go deeper into at some point, but there's a reason why a dollar keeps losing purchasing power, and I think a lot of y'all understand the reasons as to why in our lovely Federal Reserve System. But that's another option. I could leave it in cash tucked away in my house or in the backyard. Or I could put it in with a financial advisor. I could do some qualified accounts like IRAs, 401ks. I could do some HSAs. I could even start some 529 accounts for my children. But I'm giving up the control. If I go place this money somewhere else, maybe with my financial advisor or in those other qualified accounts where it's based off of the market performance, I can't control what the market's going to do. It's going to be that beast that it wants to be at the time, right? So I'm given all of these options of where I can warehouse my money at. And when I really look deeper into it, there are pros and cons to each of these different accounts. So when I think about where do I want to store the money? What are the attributes of an account if I were to store my money somewhere? Well, number one, I want to keep it liquid. So if I go and request my money, I want to make sure that I can take it back out and use it for something else. If I lock it into a 401k IRA, I'm kind of giving up that power, 529 account. But at the bank, I keep it liquid, so I understand there. And obviously, if I keep it in cash, it's liquid to me. So number one attribute is I do want to keep it liquid. Number two, I want it to grow in value, because we do have this inflation beast happening. Beast is a word today, don't know why, but we do have inflation happening, so I do want it to grow in value. I don't want to lose any of my money or lose the purchasing power if I just hoard it and stash it away in cash. So I do definitely want it to grow, but I want it to grow on a guaranteed level. I don't want to play this game of these up and down swings of markets and other factors that I just can't control. So obviously I want it to grow in value. And on top of that, I would love for it to be protected. If I'm going to leave my money somewhere, I don't want people to access it or be able to take it if I ever find myself in a bankruptcy, a divorce, I have a judgment, lien, or lawsuit against me. So I do want it to be a protected asset to me. Oh, and I failed to mention too, when it does grow, I would prefer it to be a tax-free growth over a taxable growth. Okay, I definitely want tax-free growth because the government, I already send them enough of my money. But then I also want to make sure that this is going to get transferred. My wealth will get transferred to my family without having to go through all the headaches of the probate. And when I do pass away or graduate, I want that money just to be left to them without any hassle to it. So what type of account fills all of those 5 requirements or attributes, if you will? Ding, ding, ding! If you thought of a whole life insurance policy with a mutually owned insurance company, you are the winner! Send me an email, hannah@themoneymultiplier.com, and I'll send you our ebook, Mapping Out the Millionaire Mystery. That's your prize. No, but for real though, you know, the whole life policy, when it's designed properly to have high immediate cash value, you have all of those attributes. You have liquidity, you have guaranteed growth, tax-free on top of that. It's protected in most states. And if you're a state that it's not protected in, you form a collateral assignment and now it is a protected asset. And then when I do pass away, there's that death benefit that's going to get paid out lump sum tax-free to my family. So it checks all of those boxes, but what has failed in the traditional mindset of finances in our financial world is that people were never taught properly the power of life insurance. There's kind of a reason why they call it life insurance and not so much death insurance. Am I right? Because there are these living benefits that come with this policy that we can utilize through our whole life. Ooh, that's a little punny why they called it whole life insurance. And obviously, if this is your first time here too, you do want to work with a company that is mutual. If I prefer, I'd rather work with a mutually owned insurance company over a stock held company, because then I receive the extra dividends. I'm contributing and sharing in these profits with this insurance company. And it's essentially, we're in this marriage with them. You know, I'm going to hit on this question after today's episode, but why would insurance companies even allow us to do that? That's a question I get a lot. I'm going to answer that after today's episode here. So before I bring Tess on, you saw her not too long ago in another podcast episode, and I have her back on because I thought this would be a good topic for Tess. She has spent over 30 years at a highly reputable insurance company at the home office, and she was in the accounting department there. So she saw the books of what these this insurance company was doing, and she learned a lot there. You know, now she's changed paths and now she's sharing this beautiful message of the infinite banking concept, becoming your own banker. But listen closely to what Tess has to say and write your questions down, because we will be here to help answer them. You can shoot me an email, hannah@themoneymultiplier.com, or Tess's info is going to be below if you want to reach out to her directly. And quick little reminder before we get into it, hey, Tampa's coming up, y'all. I'm so excited. I'm going to see you guys very, very soon. I have a lot of magical, fun things in the works. So snag your tickets, moneygamelive.com. Come and join us in Tampa. All right, let's get into the episode.
Hi, my name is Tess Hulack, and today I want to talk to you about this savings account scam. Before I get started, I just want to tell you a little bit about me. I am Tess Hulack. I've been with the Money Multiplier team as a money mentor for about 2 years now. I've been around Chris Nagel's campfire for probably over 6 years now. But insurance actually is it's close to my heart. It's something that has been a part of my life since out of high school. I spent 35 years, and most of those years I spent preparing regulatory statutory statements for the insurance industry. So when this idea of infinite banking came up, it was something that scared me. So just to tell you a little bit about my story, first off, I'm going to start with the idea that I think that there's a better way. And I thought that savings account were the only answer for many, many years. But really, every dollar you put into a savings account is money that you're handing over to a bank so that they can utilize the system that we're trying to teach you to help you take back control of your finances. And to give you a little bit of an idea about me, how I got involved is that during that time of lockdown, when I was stuck at home, we weren't allowed to go out, I started following different people online, and this guy named Chris Nagel started talking, and he came on multiple times, and he kept talking about this infinite banking thing, and I thought, he can't know something that I don't know, because this is my industry. I prepare the financial statements. This is mine. I understand it. So I started around the campfire, and I was afraid. I was afraid that during lockdown, even though I was in an industry that for 30 years had provided me with a job, that pandemic lockdown created uncertainty. So even for me, I was afraid to move forward because I didn't know what the future would look like. So even though everything that I studied and learned made sense, I still had fear. And how I started is one day I thought, if I don't test this, I'm never going to know. And I decided that I would take my emergency fund and I would start a policy. I was afraid because if I lost that emergency fund, I didn't know what I was going to do. I hoped I wasn't going to lose my job. I had never been in jeopardy before, but that lockdown was so uncertain. I thought I just got to try. I'm not, there's going to be negative of everything, but what I read and searched and looked at, I didn't see. I saw where this should be able to work. So what I did is I pulled my, and I didn't do this the right way, but I remember I was afraid. I was in lockdown. I pulled my emergency fund from my bank account, my savings account, set up my first policy, got through underwriting. Then as the time went past, because within the first 30 days, you can take a loan against your savings account, I withdrew the money out and I put it back in my savings account because I was still scared. But during that time, I never gave up learning, and I kept digging in, and I kept trying to understand. And what I learned about the banks is that the banks actually, and I have a picture of it here. First off, I'll show you this book. This book is kind of one of the best starting points for anybody that wants to learn about infinite banking. R. Nelson Nash, this is a really simplified book. It's an easy read, and it really, I think, makes it easier to understand the process. And this book was written in 2000, which kind of gave me some understanding to why it had more of a resurgence, because the idea of infinite banking has been around for many, 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 many years. I found movies back to the 1940s and 1950s that talked about cash value life insurance policies, and basically the infinite banking process utilizes specially engineered and designed high cash value life insurance policies. And we, in particular, use mutually owned companies that are non-direct recognition. All these things, you can check these terms on the internet, but that's what we utilize to create our banking systems. And that's what I utilized to create my first savings account. And the reason I started to decide to go down that avenue is that when I was around the campfire and I started to see what banks did with our money, it made me to realize that if everything they were saying and everything that I was researching was true, there was a better way, and I wanted to try it. So I started, like I said, with my emergency fund, scared to death that something was going to blow up. But if I didn't try, I would never know. And I didn't have an opportunity to make things better if I didn't take a chance. So I'll give you this. Many of you that have been around the campfire have probably seen this before. But this is kind of the idea of creating your own bank. And that started with me by utilizing my savings account that I was putting into this system and not utilizing myself. So instead of putting it into the system and letting the bank use my money, I pulled it out into a high cash value life insurance policy and created my own system. So just kind of wanted to give you an idea why we say that a savings account is basically giving your money away to a bank is because in this process, if I'm remembering right, here's your deposit. You're putting your money in for your savings account. You drop it into the bank. The bank turns around and takes that money and they loan it out to somebody for credit cards. Then these people make these payments and they drop it back in. It gets loaned out for a house. It gets loaned out for a car. It gets loaned out for a college education. It gets loaned out for debt consolidation. So that same dollar in the banking system, they get to keep recycling your same money, and they're making huge amounts of money. Like I want to say it's like 1,500% they can make off of your money. So basically, even if you want to take it simple, even if they're making 20% and you're making like 5%, they're still making more money than you. But it's a lot bigger than that. It's a lot bigger. But sometimes you have to start small and start to practice, and then you can move forward. But in any case, this kind of shows you that they keep putting it in a circle. Well, the idea of what this whole process is for you to learn to become your own bank so that you can put this process together for you. Because you were never meant to live with financial handcuffs. Your money needs to work for you. It doesn't need to work for institutions. I really have a theory or a thought, and I think that a lot of the pain and the hurt that we have in the world right now is because many people are living with financial handcuffs. And if they can utilize a system like this, take back control, learn it, because you need to learn it, and it is a marathon. It takes some time to get this system built and running. But if you can take back financial control, I think then you can follow your heart, mind, soul alignment. What is the purpose that you were brought here? What did God bring you here? What did you decide you wanted to come here for? And you can do it without the financial handcuffs that I think have caused so much pain for so many of us. So the whole thing is that I believe the world changes the moment you stop outsourcing your financial control to a banking institution. We've been taught that that's the way to do it. And now through this process, the one thing that kind of makes me sad is that I worked in the industry for many, many years, and I didn't know this existed. And if I had known, I think there would have been more confidence for me because I was inside the four walls. But back to this idea of this book, The Infinite Banking Process, Becoming Your Own Banker, it kind of had a resurgence with R. Nelson Nash when he put this book out in the year 2000. But as I will tell you is that in researching and digging in and learning, I found that people are referring to cash value life insurance policies way back into the 1940s, 1950s. And it goes back even further than that. I was studying because I'm already 2 years in, so I need to get continuing education to keep my license current. And I was studying where they were actually showing how insurance started developing way back in I want to say it was the 1500s, because wealthy merchants would put together pools and they would actually write dollar amounts that they were going to support a ship, because if a ship sunk, that would be a lot of people impacted. And they would write a dollar amount on a sheet of paper and then they would sign beneath it. And that's the origination of the word underwriter. And they would do that to kind of move these policies forward. But the idea is that you want to take back control of your savings. And I think this is really an easy place to start. If the whole idea of like the 6 rules of wealth is, number one is that you pay yourself first, and you pay yourself at least 10%. And that idea is that emergency fund. So many people don't have an emergency fund, but if you do have an emergency fund, wouldn't it be beneficial to maybe put it into play inside of an infinite banking policy so that you could learn the process, keep the money in your own family system, compound that interest, be able to take a loan against your infinite bank. Just as an example, I had a person recently tell me that they got a car, and when they got the car, they actually took a used car off the lot and it didn't have oil in it. And when they got it home, the transmission burned up. Because if you know anything about a car, yeah, I'm a Detroit girl, so your car without oil is like your body without blood. That's one thing my dad told me from the time I was old enough to drive. Do not ever show up in my driveway with a car that has a seized transmission because it didn't have oil. In his opinion, there's never an excuse for that. But I digress. So anyways, if you had something happen and you had $5,000 because your transmission froze up on your car, could you cover it? Wouldn't it be nice if you had a banking system where you don't have to ask the bank permission, you don't have to go through the underwriting, they don't have to pull your credit, you don't have to go through that whole process, you can actually utilize your cash value life insurance policy. They're specially engineered and designed, high cash value, so that you can utilize them for your banking system. And basically, you can become the bank. You can learn the steps so that you can put your money to work just in the same way that the banks put the money to work when you put it into their account. So I think that's what's beautiful about this whole system. The banking system is giving you a little bit, but they're taking back control. And we've gotten used to giving that control away. The fractional reserve idea, banking systems operate under fiat money. So they have the ability to make our money work a whole lot harder for them than we can. But we can take back control and keep it internal. And we have the ability to utilize compound interest so that we can continue to grow and grow and grow. So I think the idea is that we want to start somewhere. And for many, they don't know where to start. For me, I started with a savings account because what I understand is that my savings account wasn't earning any money. In a banking system, they're only going to give me enough to kind of keep that money in there. And then they're going to control the money. They're going to tell me when I can, like I can remember once my parents wanted to take a bond that they had held for many, many years and cash it in. And the bank said, and it wasn't a big amount. We're sorry, but we need a couple days notice before we can do that. Well, if you have your own banking system, you have the ability. Now, granted, you're working with an insurance company, so you're going to actually have to fill out a paper. But the paper is really basically, what's my account number, given an approval, and they'll give you money if there's cash value available. So it's not like you're going to have to be underwritten and you're going to have credit reports pulled and you're going to have to sign a contract that you're going to pay a certain amount per month. Now, the idea is you want to do that because you're paying it back to yourself, but you get to make the rules. You don't have somebody else making the rules on your behalf, because the process is a good process, but it needs to be a process that you yourself control. So the idea is that we know that banks have paid really small amounts. I mean, there was a period of time you were making like 0.01%. I know there's a little higher interest rate right now, but we're kind of turning around. Like I'm even noticing with bank accounts that I have that the interest rate is going back down again. So it went up a little bit, but it's going down again. But wouldn't it be nice if you can do that recycle and recapture inside your own banking system? Really, if you think about the current setup of savings accounts, they're not set up to where you're ever going to make a lot of money. They're never making more money than, say, what the inflation. I went blank on the word inflation. Your savings account aren't making more money than inflation. So the idea is if you set up your banking system, you utilize it so that you can keep your base within your banking system. You pay interest to the insurance company because they actually loan you money out of their general fund, but you keep that base growing and compounding. You have more of an opportunity to move the needle forward. And there are some techniques that have been taught. You can learn to become your own bank and loan your money out, kind of like the banks did. So we actually, through the process, learn so that we can mirror what the banks are doing.
Hey, money multipliers, pardon the interruption, just really quick. I want to get real with y'all. If you've been carrying around this weight of your financial life by yourself alone, the stress, the confusion, that feeling that you should be farther ahead than where you're at right now, you don't got to keep doing things the hard way. Money Game Live in Tampa, this is a space where people come to finally break free, to rewrite their money story, to stop surviving and start building the life they know that they're meant for. And I'm telling you that something powerful happens when you get into a room of people who are done playing small, who are ready to take back control of their future. You see what's possible. You get the clarity. You meet the people who have done it and been there before. And then you start to feel the hope again. But Tampa is just a couple of months away. It's coming up very, very close, and seats are disappearing. So if this is something that's been kind of whispering to you, hey, I need this, listen to that gut feeling. So go snag your tickets, moneygamelive.com, and give your chance just to breathe again, to grow, and just to believe in yourself. So this is going to be your breakthrough moment, and all you got to do is just show up. And as my yoga teacher always says, showing up is 50% of the work. I will see all of you money multipliers in Tampa.
Banks sell us liquidity as safety. They tell us that everything is liquid and fast, but what we don't know is that it's not growing very fast. It's kind of a financial parking lot. We put our money there and we don't have any control. The growth is very limited, and it's kind of like false security in a way, because there's an FDIC reserve so that you can get, they say like $250,000 is guaranteed, and for the most part they've paid that. But in the case of there's a reserve there, if all the banks went down at once, they're going to only be able to pay whatever that reserve is. In your case, you're kind of backed up by an insurance company, and insurance companies don't operate under this fiat money. They operate under, but it's an Austrian economic system where there's reserve dollars to back up all the money that you have. Our banking systems now operate under fiat money, so they do not have to back up the money in the accounts. It's not like the gold standard like it used to. They don't back up the money in a bank. They don't have to back it up with anything anymore. They used to have to back it up with gold, but they don't anymore. Insurance companies, because they're operating under the idea that one day you're going to pass and there's a life benefit, there's a death benefit to this insurance policy, they have to have reserves set up and monitor to make sure that at any point in time your death benefits are going to be paid. So I think that that's really an important part about these savings accounts. I was thinking about something too, like if a stranger came to you and wanted to borrow your money and they paid you almost nothing in interest, but they made huge profits off of it. If they became their own bank, like I showed you with this book, if they actually went out there, you loaned somebody every bit of money that you had, and you turned around and found out that they created their own system and they were making tons and tons of money off of your money, how would you feel about that? Would you want to change the rules? And if you would want to change the rules, why don't you want to take back those rules from a banking system? Why don't you want to learn that for yourself? I know it takes some time to learn something new, but I think sometimes the best gift we can give ourselves is to be open to learn something new. When I found out this process, I'm going to tell you, it scared me at first, but I made sure that there's a rule around this campfire. Don't do anything that you don't know, like, and understand, because you'll get yourself into trouble if you don't. But what I'm hoping to do is, by talking to you about my experience and being fearful, I opened up my policy with my emergency money during the lockdown. And I was scared. If I lost that money, what was I going to do? How was I going to pick up the pieces? Who was I going to go after? Because nobody was working in an office in those days. But I took the chance, and it worked out to my benefit. And now, 6 years later, I'm working in this area. I'm still in the insurance industry because it is my heart, but I'm helping other people to understand this process. But where would I be if I hadn't taken a chance to dig in and to learn? And through education, I understand how this process works. So it's like the beginning step. I kind of think the savings account is really the beginning step all the way around. Like if you look at the idea, what is the first thing they tell us? What's the first law of wealth? The first law of wealth is that you save 10%, and you're supposed to pay yourself first. Pay yourself first and pay yourself 10%. So I kind of call that is like the first law of wealth, but wouldn't that be the first place to start? Wouldn't that be a great way to kind of dig in, get your feet wet, and to learn this process so that you can become your own bank? And this isn't a process that's new. There's a movie it's Henry Fonda and Alfred Hitchcock from 1956, and my mom told me about it, and it's called The Wrong Man. And the idea of just kind of an overview in case it kind of slipped away through this process, we use specially engineered and designed whole life policies with a high cash value. We take a reduced commission so that there's more cash value for our clients. We utilize mutually owned insurance companies because in a mutually owned insurance company, the policy holder is more or less an owner of the company. So you benefit by any benefits that the company makes through the process of dividends. We also write with what's called non-direct recognition insurance companies, which means that when you take a loan against the cash value of your policy, that remains in the account because from the insurance company's perspective, it's a mutually owned company. So you're kind of an owner of the company. They know that what every one of us is going to die one day. They have a death benefit. The cash value is just the amount that you've paid in and any interest and dividends you've earned, but they allow you to utilize that as a living benefit. And then if anything happens and you have money that you owe and you happen to pass, they'll just reduce your death benefit by that living benefit. So there's so many things all the way around this that are, there's protections. Because the one thing I learned from 30 years in the insurance industry and the accounting department is they oversee everything, and to big degrees. Like, we had internal auditors, we had external auditors, we had to have audits signed off on every year. We had to file a model audit rule. We had to file who our auditors were because they couldn't be on the account for any more than 5 years. They looked at nepotism. They looked at actuarial reports. We had internal actuarial reports. We had external actuarial sign-offs. We have Ambest, who is rating everybody. And if you go through these IRIS ratios, I forget the acronym that it stands for, but if you go through these IRIS ratios, you have to be reviewed, and if anything falls out of the normal range, you got to answer for it. So there's so many things that back up an insurance company that there's some stability. Not some, there's a lot of stability there. And for me, I feel very confident in that stability because that's the industry that I worked in my whole life. So what I first took the jump was in my savings account. I moved my savings account over because that felt like the safe, and I did it because that felt like the safest thing. In lockdown, it felt like the safest area to go. But I think for many people, they may not even have a savings account. So why not get started in this process and utilize that as a savings account? Then if you happen to be the one, and I don't want this to happen to any of you, but you have the transmission that goes because there's no oil in it, please check the oil. You have a backup tool. And the good thing about this backup tool too is I even shifted at one point to put money, like if my company gave me an employer match, I would actually only go up to the match and I put the rest into my policies. And granted, you have to have the policies underwritten. So that's something you want to talk to a mentor about to help guide you through. But I would rather put that money in there where I have control of it. Because if it's my banking system, I can decide if there's cash value I want to take a loan. I don't get a penalty because I'm not 59 and a half. So there's a lot of things that I can monitor and I can control if I follow the rules and I understand the process, that if I go into a 401k, there are benefits to 401ks, and your employer will give you matches and stuff. But for me, through what I learned, I wouldn't put any more in the 401k than what is matched, because there are the rules that they get to use your money. You don't get to. And when you have this policy over here, you have the ability to use it. So I think that that's some of the really benefits of it. And I know I could go into a lot of numbers, and I know I showed you this picture and, you know, the percentages, and you can look at Bauer Financial and they'll kind of tell you like some of these percentages. But I wanted to talk to you like as me, this person, how did I get started in this process? And I'm going to tell you that I was scared to death to get involved in it, but I was able to learn and to follow, and it started with Chris Noggle, and for 6 years I've been following him, and Hannah Kessler's the Money Multiplier, and I've been able to learn through everybody. And when I learned, I also knew what I knew from being in the industry, from being through the audits, from being through the I've actually, and if anybody is connected, MSTV, I've done some, like I work for a company that actually had the regulators come in and say, hey, we told you what we wanted, and you're not doing it exactly the way we want. So this is what we're going to do, and they do come in for that. So it's an industry that I know because it's an industry that I lived for 30 years on the inside, and then I came to the outside because I believe in what this process is so much. So I guess really what I want to say is that if you can take that savings account and you can put it into this tool that will compound, you take loans against it, it will compound and it will grow, and you can operate it like a savings account, and taking out of the savings account that's in a bank where they use fiat money and they have control of it, why not put it into a system that you can control? And then the really beautiful part about it is it's not just your banking system, but it's also a death benefit. So the day that you're no longer here, you've also protected your family. You've also left a legacy for the next generation to move on. You know, there's books involved in this, like Garrett Gunderson, and actually I'm going to go to an event and meet him fairly soon, but Garrett Gunderson wrote the book, What Would the Rockefellers Do? And I think that there's a lot of these tools out here that I've been introduced to through this campfire so that I can understand and learn and move forward so that I can make this an even better tool. So I think the first thing that we have to do, all of us, is to stop and say, where am I at, and am I giving control to somebody else? And is this something that I can dig in and learn and understand and take back control myself? And who do I trust to help me in the process? I will tell you, I came into it to prove Chris Noggle a scam, and he just laughs at me when I tell him now, because he says he got into this for the same reason. He was actually writing policies and he thought it was a scam. So he forgave me for thinking that, but I had to dig in and I had to learn and I had to understand. And that's all I would ask for you is, are there some tools that maybe you can make work better for you? Because right now you don't understand. We were all taught a certain way. I was told, get that 401k, get it to max. If I had known about this process, even though I would still take the matches from my employer and things like that, why not have two tools available? Because the one thing I've learned through the past 6 years is I don't want all my eggs in one basket. I want to have these policies. I want to like take this money and private lend over here. You know, there's different tools, but those tools require education. And I think the fastest place or the place to start is the idea of is a savings account, is a getting a policy started. But the good part is if you actually call the team, if you have the ability to start something even a little bit, like maybe you have a plan to buy a car, we can help you set up a plan so that you can set up for a car, or if you want to set up for like your children so that they can be set up for the rest of their lives, because there are a lot of family members. I would say the biggest percentage of what I've written in the past year, Linus, Nolt, and I are partners, and we work together for our clients. But the most policy, I would say that we have more children's policies than we do adults, but I'm okay with that because these policies will continue to grow. And if they continue to make the premium payments, these children are going to have these policies that are going to be a tool that they save. So what I wanted to say as I kind of close this up is this something you've been wondering about? Is this something that you should get started with? Is this an idea of a savings account? Give your chance an opportunity to know, like, and understand. You know, your savings account, it isn't broken. It's working exactly as they designed it to, but it's just not working for you. Banks build skyscrapers with all the money that we give to them. We don't have a savings problem. We have a financial education problem. The real scam isn't the bank, but it's what nobody explained to us. And I hope you give yourself a chance. Dig in, learn something new. You might find that you know, like, and understand it and create a new future for yourself and for your family. Thank you for your time, and we'll talk again really soon.
Thank you, Tess, for joining us today. So hey, reminder too, if you want to reach out to Tess directly, her info is going to be down below. But before you go, I have a quick little exercise that I want to do. If you are ever sitting at a table, maybe with your family or friends, and you're starting to talk about the infinite banking concept, here is a quick napkin diagram that you could pick up and that you can do, whether you're at a restaurant, at your house. So I picked up the napkin, and actually it's my leftovers from my white elephant party. I'm not going to read it, but for all my YouTube people, it's kind of silly. It's funny. So I'm going to pick up this napkin, and here's what I want you all to do. We're going to draw a big L on the napkin, just like this. Okay? And the horizontal line, this is our timeline. We're going to make a little line graph. Horizontal line is our time graph, and the vertical line is our money graph, okay? You see it right there? Now, here's the differences, right? Because you finance every single thing that you buy. Yes, it's important of where we're storing our money, and to that, it's important because it dictates how we're financing this transaction. Example, if I am keeping my money in a savings or checking account and I'm saving up for purchases, taxes, investments, gifts for the family, it don't matter what it is. Here's what you're doing. You're starting right here on the 0 line, and you're going up, up, up. You pay cash for the item. Now you're back at zero. You got to save, 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 back up again. You buy the item or product or service. Now you're back at zero. Again, we're going to save, save, save up. Then we go buy it. We're back at zero. So you can see the whole bunch of triangles right there on my napkin. This is us saving and paying cash for things. It's great to pay cash because I bought it and I don't have to outsource the financing or pay interest elsewhere. But number one, you've got to immediately start saving back up for that next purchase, next investment or item. And then number two, you're missing out on the interest that you could have earned because you paid cash for it. You literally had to go in there, withdraw the money out of your checking, savings, CD account, pay cash for it, and now you're no longer earning interest on that money. Okay, so you got to go out there, work for it to get it back in your pocket, making it interest again. Let's do the second step of financing, banks. Well, I don't have the money, so I got to go borrow it from the bank. So at my $0 line, I'm immediately in the hole down. And then I start saving back up little by little. I'm back at the $0 mark. I go down and I got to bank finance something else. And then I pay it back over time, little by little. And then I'm back at the $0 mark. Okay, you see underneath in my zeros, you see how it starts going down now? This is us financing things through banks. I don't got the money, so I got to go bank financing it. And then obviously I'm back at zero and I paid out the interest to that bank. So the bank made some money on me. Here's what we're doing with the policies to give you a visual representation. When I open that policy, I'm immediately going to have cash value. So I'm going to start a little bit up on my money line. So I'm going to have some cash value. And this cash value is guaranteed to grow and grow and grow over the course of my whole entire life. So I kind of made like a little squiggly line, if you will. And this is me building up cash value inside of my policy. We're going to call this IBC right next to it. I should also label out cash over here, bank down here. Okay, here's my little notes that I just added, okay? Pause the video if you need to. Let's say I'm going to go finance something through my policy. Same thing that you would have done. You were just taking out the cash from the policy now to go do this. So let's say like in year 5, I want to go and buy myself something. I take out the cash value and then little by little, I'm paying it back to the policy. Then year 10, I want to go buy something else. I'm going to take the cash value out and then little by little, I'm going to pay it back into the policy. So these blocked lines up here, wait, how can I see this? It's right here. These blocked lines right here, this is my cash value that continues to keep growing and growing. This is me taking out the policy loan, and then I'm paying back my policy loan little by little on my terms. Because remember, you're in control of this transaction. You get to decide if you want to pay yourself back, when you want to pay it back, yada, yada, yada. You're in control of it. So my cash continues to grow and compound even though I'm using it. The opportunity cost of our money. That's all this is, just opportunity cost. And we need to start learning how money actually works. So the question I wanted to answer at the end of this episode, why do these insurance companies allow us to even do this? Well, here's the answer. When us as money mentors or the agent who is selling you the policy, because you got to go through an agent, a life insurance agent, to even get this policy, okay? And when I am selling you this policy, if I'm a good mentor and a good coach, I'm going to continue to educate you on this policy. I'm going to continue to educate over and over every single year. This is why we have the implementation team. If you are a policyholder with the Money Multiplier, you have Larry Richard, Jerome, you have Ethan Evans, you got Wesley. You have people there who check in with you every quarter for the life of the policy, and they're constantly updating those visual tools that we build out as well, whether it's the Money Multiplier map or the cash flow analysis. And yeah, it's a free service that we do for all of our members. So if I am a good coach, you will want to, and you will know why you want to pay those premiums as much as you can and for as long as you can. And when people are properly taught the power of high immediate whole life insurance policies, high immediate cash value whole life policies, you'll never want to quit. And so that's why these insurance companies love this stuff, because we have to pay those premiums. I call them premium deposits, but it is a premium. And when I pay those premiums into my policy, the insurance company always has new capital coming back in. They love it. They want that good business on their books. And then on top of that, when we take out policy loans, yes, you can withdraw the money from your policy. I wouldn't recommend it in the early years, but it is an option if you do just want to simply withdraw the cash. But the reason we do our policy loans is because then I'm not well, then let's cut that out. Why I take out policy loans is because then I'm not interrupting the compounding that's happening inside of this vehicle. So I'm using the money and I'm still earning guaranteed interest and dividends as if I never touched my money. Because when we take out policy loans, we're borrowing from the general funds of the insurance company. And when I borrow from the general funds of the insurance company, they charge me policy loan interest. So the insurance company is making some profits by loaning us their money. But here's the big difference. Why do I always say we want to work with mutually owned companies? Here's the thought pattern that you got to shift in your head. I love paying my policy loan interest, because when I pay that policy loan interest, I'm creating profits for the insurance company and on their books. And who shares in the profits at the end of the year in a form of a dividend? Me, the policy holder. So I'm just going to see that loan interest come back to me that I paid in a form of a dividend anyways. It's a mindset shift that you got to get around. You got to start thinking like a business owner, like a banker really does. Loans are assets to banks. Your policy loan should be an asset to you and to the insurance company. Their policy loans are assets to them too. So this is why they allow us to do it, because when it's properly taught, the infinite banking concept, they know that they're always going to have premiums coming in. They know that they're going to be profitable. It's going to be good business on their books. And they're not in this for wanting to take advantage of people. I know like the insurance world, whether it's health insurance, fire, flood, even life insurance, a lot of the term insurance policies, it gets a bad rep because these insurance companies, they don't want to pay. And I get it. I mean, when my van flooded, I had to total that thing out, and I was fighting with the insurance company to send me a damn check because Mother Nature happened and the van flooded and it got totaled. So I can understand the experiences there, but I do encourage y'all just to have a different lens when you're looking at it from a life insurance perspective. I mean, seriously, with the 6 companies that I just personally do business with, this just happened actually last week. I had a client. He passed away. His wife calls me up and says, "Hey, I'm sorry to tell you, but my husband passed and I need your help with the death benefit claim." So I got in there and I started to help her. Well, come to find out, we've been nagging this individual for some months now because he was behind on his premium. He wasn't paying the premium. It was in the grace period, actually to the point that it lapsed back in November of 25. Well, I'm going through and we're submitting the claim paperwork, and I didn't say anything at first but I saw it. I could see that the policy lapsed in November. I called up this insurance company and I said, hey, look, here's what's going on. This is the reason why he wasn't paying the premium. Now he passed away, the mother's calling, and I think we need to pay out this death benefit claim. And luckily, because he's had his policy since 2016, the insurance company saw those 9 years of him paying his premium, and they said, you know what, we understand, we're gonna pay out this death benefit to the family. Legally, the insurance company didn't have to do it because contractually, contract law, the policy was lapsed, but they're good people at the core of these mutually owned insurance companies. They're humans just like you and I. And so when you get into the rooms with the right people, they're going to do the right thing. Seriously. I don't know how I got off on that tangent, that story. But oh, the bad rep, okay? Because I just want to encourage y'all to think a little bit more positively about these insurance companies. They're not out to get you. Mutually owned insurance companies, or maybe I can only vouch for the 6 that I personally work with, who I have my 8 policies through. But it's some cool stuff, man. You just gotta rethink the thinking. You gotta be a sponge, keep absorbing this information. As Nelson would always say, never hit the arrival syndrome. But I will be here. All right, y'all know how to get a hold of me. Send me an email, hannah@themoneymultiplier.com. Hannah spelled the same ways, forwards and backwards. And come and join us in Tampa. All right, I got all my top experts coming out. I'm gonna show you exactly what I'm doing to create. I'm up to a little under $10,000 a month as passive income coming in from my investments that I do. I wanna show you what I've been doing, how I get those numbers, and that's just passive. I'm hopefully, what I would like to do is double that this year, but I have some other projects that I really kind of want to work on within my business. I'm trying to figure it out. But the good news is we got started, right? We got some passive cash flow coming in, and that's what it's all about, right? You don't want your pocketbook to dictate how you spend your time, where you're spending it at, and I just really want y'all to live your life on your own terms. Anywho, thank you for joining me for another episode of the Money Multiplier podcast. And hey, come and join me this Thursday. I go live 9 a.m. Eastern time every Thursday for Money Mornings with Hannah. You can catch that on the YouTube, LinkedIn, my Facebook page, Hannah Kessler, and then also even Instagram. I go live over there. So come and join me for the live stream. I do a live Q&A, and I got different topics I get into every Thursday morning as well. And I will see all of you in person in Tampa, moneygamelive.com. All right, y'all, till next week. Have a wonderful day. I'll catch you then. Bye, everyone. Thank you, Money Multipliers, for tuning in to another episode. If you like this stuff and you want to learn more about the infinite banking concept, click right here. It will take you to my powerful 90-minute presentation. Until then, be well, do great. I'll see y'all next week.